Today, I am going to share a special thing with you all, the audio version of Candlestick Trading Bible, written by Munehisa Honma. If you haven't heard the name Munehisa Honma, then know that he is widely known as the father of candlestick charting. Honma was a successful rice merchant in 18th century Japan, and his work laid the foundation for modern candlestick patterns, which many traders like me still rely on today. If you want to deeply understand the psychology and strategy behind price action, then this audiobook is a must-listen. Honma's method primarily emphasizes reading the market sentiment through candlestick patterns and making well-thought-out decisions accordingly. This book is truly powerful because it not only teaches you about the patterns, but also the market psychology behind them, which can give you an extra edge in your trading journey. Some important topics you will learn are how to interpret bullish and bearish patterns to anticipate market movements, why understanding market cycles and trader psychology is important, and Honma's methods of risk management and self-discipline, which perfectly align with some of the core components we always emphasize in trading for life. So if you want to improve your technical analysis skills and understand market trends better, this audiobook is a valuable asset for your collection. If you have already read the book or plan to, let me know in the comments. If you haven't subscribed yet to get more insights, strategies, and tips for mastering the art of trading, then subscribe now. Happy learning, and always remember, first demo, master the skill, and trade for life. Candlestick Trading Bible. Introduction. Candlestick Trading Bible is one of the most powerful trading systems in history. It was invented by Honma Munehisa, the father of candlestick chart patterns. This trader is regarded as the most successful trader in history. In his time, he was known as the God of Markets. His invention brought him more than $10 billion in today's money. I have spent 10 years compiling, testing, organizing, and regularly updating this method to create my own new version, which is considered the easiest and most profitable trading system. The Candlestick Trading Bible is the trading method that will finally put your trading on the right track: regular, profitable, easy, and requiring very little time and effort. This trading system is based on a combination of Japanese candlesticks and technical analysis. You only have to do one thing, and that is to spend as much time as possible mastering the method I am about to share with you and using it to trade any financial market. Learning Japanese candlesticks is like learning a new language. Imagine you get a book written in a foreign language. You look at the pages, but you can't understand anything written. The same applies to the financial markets. If you don't know how to read Japanese candlesticks, you will never be able to trade in the market. Japanese candlesticks are the language of the financial markets. If you master the skill of reading charts, you will be able to understand what the market is trying to tell you and make the right decisions at the right time. The easy-to-follow strategies in this work will give you profitable techniques that are quick to learn. More importantly, learning the principles of market psychology behind the candlestick method will change your overall trading mindset forever.
The Candlestick Trading Bible has already proven itself. A lot of wealth has been generated using Japanese candlestick techniques. I congratulate you on taking the first step in your trading education. You are on the right path to becoming an advanced trader. However, this is just the beginning of your trading career. After you finish this ebook, the real work will begin. Don't read this ebook too quickly. It's not a novel. You should take your time to understand the concepts I have discussed, make your notes, and come back from time to time to review the strategies I have shared. Remember, this is an educational work that will teach you a professional way of how to make money trading in the financial markets. If you can acquire the skills I have shared with you here, you will be able to completely change your life and the lives of those around you. Review. The ebook is divided into the following sections. Candlestick anatomy. Just like humans, candlesticks have bodies of different sizes, and in trading, it's important to examine the bodies of the candlesticks and understand the psychology behind them. You will learn this in this section. Candlestick patterns. Candlestick patterns are an integral part of technical analysis. Candlestick patterns are formed because human actions and reactions are patterned and constantly repeated. In this section, you will learn how to recognize the most important candlestick patterns, the psychology behind their formation, and what they indicate when they are formed in the market. Market structure. In this section, you will learn how to identify trending markets, ranging markets, and choppy markets. You will learn how these markets move and how to trade in them professionally. You will also learn how to draw support, resistance, and trend lines. Time frames and top-down analysis. As a price-action trader, it's very important for you to analyze multiple time frames. In this section, you will learn how to analyze the market using the top-down analysis method. Trading tactics and strategies. In this section, you will learn how to trade using 4 price-action trading strategies: the pin bar strategy, the engulfing bar strategy, the inside bar strategy, and the inside bar false breakout strategy with trade examples. I strongly recommend that you master the previous sections before jumping into this section, because if you don't master the basics, you won't be able to use these strategies as effectively as you should. In this section, you will learn how to identify high-probability setups in the market and how to use these candlestick patterns in trending and ranging markets to maximize your profits. Money management. In this section, you will learn how to create a money management and risk control plan that will help you protect your trading capital and be consistently profitable. History of candlesticks. Candlesticks are much older than anything that existed in the Western world. The Japanese were looking at charts as far back as the 17th century, whereas the oldest known charts in the United States appeared in the late 19th century. In Japan, rice trading was established in 1654, followed by trading in gold, silver, and mustard oil. At this time, the rice market dominated Japan and seemed to have become more important than hard currency. Munehisa Honma, also known as Sokyu Honma, a Japanese rice merchant born in the early 1700s, is widely known as one of the first pioneers of price action tracking. He understood the basic dynamics of supply and demand, but he also identified the fact that emotion plays a role in determining prices. He wanted to track the emotions of the market players, and this work became the foundation of candlestick analysis. He was highly respected, so much so that he was elevated to the rank of a samurai. The Japanese did an excellent job of keeping candlesticks a secret to the Western world until the 1980s, when a major cross-pollination occurred among banks and financial institutions worldwide. It was during this time that the Western world suddenly became aware of these mysterious charts. Obviously, at this time, charting in general had become much easier due to the widespread use of PCs. In the late 1980s, several Western analysts became interested in candlesticks. In the UK, Michael Finney, who was then the head of Sumitomo's Tan London, began using candlesticks in his daily work and started introducing the concepts to London professionals. In the December 1989 edition of Futures magazine, Steve Nissen, a technical analyst at Merrill Lynch in New York, produced a paper in which he showed a series of candlestick reversal patterns and explained their predictive power. He went on to write a book on the subject, and it was an excellent book as well. Thanks to Mr. Finney and Nissen, candlesticks have gained popularity over the years, and today it seems to be the standard template that most analysts work with.
Why are candlesticks important in your trading analysis? Candlesticks are important in your trading analysis because they are considered a visual representation of what's happening in the market. By looking at a candlestick, we can get valuable information about the open, high, low, and close price, which will give us an idea about the price movement. Candlesticks are flexible.
They can be used alone or in combination with technical analysis tools like moving averages and momentum oscillators. They can also be used with methods like Dow theory or Elliott wave theory. I personally use candlesticks with support and resistance, trend lines, and other technical tools that you will discover in later chapters. Human behavior related to money is always influenced by fear, greed, and hope. Candlestick analysis will help us understand these shifting psychological factors by showing us how buyers and sellers interact with each other. Candlesticks provide more valuable information than bar charts, making them a win-win situation to use because you get all the trading signals generated from bar charts, plus the additional clarity and extra signals generated by candlesticks. Candlesticks are used by most professional traders, banks, and hedge funds. These people trade millions of dollars every day. They can move the market when they want to. If you don't understand the game, they can easily take your money. Even if you can trade a $100,000 trading account, you can't move the market or control what's happening in it. By using candlestick patterns, you will understand what the big players are doing, and it will show you when to enter, when to exit, and when to stay away from the market. What is a candlestick? Japanese candlesticks are formed using the open, high, low, and close of a selected time frame. If the close is above the open, we can say that the candlestick is bullish, which means that the market is increasing during this time. Bullish candlesticks are always displayed as white candlesticks. Most trading platforms use the color white to signify bullish candlesticks. But the color doesn't matter. You can use any color you like. The most important thing is the open price and the close price. If the close is below the open, we can say that the candlestick is bearish, which indicates that the market is falling in this session. Bearish candles are always displayed as black candlesticks. But this is not a rule. You can use different colors to differentiate between bullish and bearish candlesticks. The filled part of the candlestick is called the real body. The thin lines that stick out above and below the body are called the shadows. The top of the upper shadow is the high, the bottom of the lower shadow is the low. Candlestick body size. Candlesticks have different sized bodies. Long bodies indicate strong buying or selling pressure. If there's a candlestick whose close is above the open and has a long body, it indicates that buyers are strong and they are taking control of the market during this time. Conversely, if there is a bearish candlestick whose open is above the close and has a long body, it means that selling pressure is controlling the market within this selected time frame. Short and small bodies indicate little buying or selling activity. Candlestick shadow, tail. The upper and lower shadows give us important information about the trading session. The upper shadow indicates the high of the session, the lower shadow indicates the low of the session. Candlesticks with long shadows show that trading activity occurs well outside the open and close. Japanese candlesticks with short shadows indicate that most of the trading activity was confined near the open and close. If a candlestick has a long upper shadow and a short lower shadow, it means that buyers showed their strength and pushed the price higher, but for some reason sellers came in and finished the session by bringing the price back near its open price. If a Japanese candlestick has a long lower shadow and a short upper shadow, it means that sellers showed their strength and pushed the price lower, but for some reason buyers came in and finished the session by bringing the price back near its open price.
Candlestick patterns. Candlestick patterns are one of the most powerful trading ideas. They are simple, easy to spot, and very profitable setups. A study confirmed that candlestick patterns have a high predictive value and can generate positive results. I have personally been trading candlestick patterns for more than 20 years. I can't switch to any other method because I have tried thousands of strategies and trading methods but didn't get any results. I'm not going to introduce you to a holy grail. This trading system works, but be prepared to lose some trades. Losing is part of this game. If you are looking for a 100% winning system, I strongly recommend you stop trading and go find another business. Candlestick patterns are the language of the market. Imagine you are living in a foreign country and you can't speak the language. If you can't say a word, how will you survive? It's difficult, isn't it? The same thing applies to trading. If you know how to read candlestick patterns correctly, you will understand what these patterns are telling you about market dynamics and trader behavior. This skill will help you better enter and exit the market at the right time. In other words, it will help you operate differently in the market and make money by following the footsteps of the smart players. The candlestick patterns I'm going to show you here are the most important patterns you will find in the market. In this chapter, I'm not going to show you how to trade them because it will be explained in the next chapters. What I want you to do is focus on the structure of the pattern and the psychology behind its formation, because this will help you gain the skill of easily spotting any pattern you find in the market and understanding what it's telling you to do next. If you can acquire the skill, you will be ready to understand and master the trading tactics and strategies I'm going to teach you in the following chapters. Engulfing bar candlestick pattern. As the name suggests, an engulfing bar forms when it completely engulfs the previous candle. An engulfing bar can engulf more than one previous candle, but to be considered an engulfing bar, it must completely engulf at least one candle. Bearish engulfing is one of the most significant candlestick patterns. This pattern consists of two bodies. The first body is smaller than the second. In other words, the second body engulfs the previous one. See the image below. This is what a bearish engulfing bar pattern looks like on your chart. This candlestick pattern gives us valuable information about the bulls and bears in the market. In the case of a bearish engulfing bar, this pattern tells us that the sellers are in control of the market. When this pattern occurs at the end of an uptrend, it indicates that the buyers are being overwhelmed by the sellers, which signals a trend reversal. Look at the example below. As you can see, when this price action pattern occurs in an uptrend, we can anticipate a trend reversal because the buyers are no longer in control of the market and the sellers are trying to push the market down. You can't trade every bearish candlestick pattern you find on your chart. You'll need other technical tools to confirm your entries. We'll talk about this in detail in later chapters. For now, I just want you to open your charts and try to identify all the bearish engulfing bar patterns you find.
Bullish engulfing bar pattern. The bullish engulfing bar is composed of two candlesticks. The first is the small body, and the second is the engulfing candle. Look at the image. The bullish engulfing bar pattern tells us that the market is no longer in control of the sellers, and the buyers are going to take control of the market. When a bullish engulfing candle forms in the context of an uptrend, it indicates a signal of continuation. When a bullish engulfing candle forms at the end of a downtrend, the reversal is much stronger because it represents a capitulation bottom. Look at the example below. The example above clearly shows us how the market changes direction after a bullish engulfing bar pattern is formed. The small body, which represents the selling power, was enveloped by the second body, which represents the buying power. The colors of the bodies are not important. What is important is that the small one is completely engulfed by the second candlestick. Don't try to trade the market using this price action setup alone, because you'll need other confluence factors to decide if the pattern is worth trading. I'll talk about this in later chapters. What I want you to do now is to master the skill of identifying bearish and bullish engulfing bars on your chart. This is the most important step for the moment. Doji candlestick pattern. The doji is one of the most important Japanese candlestick patterns. When this candlestick forms, it tells us that the market opened and closed at the same price, which means there is equality and indecision between buyers and sellers. No one is in control of the market. Look at the example below. As you can see, the opening price is equal to the closing price. This signal means that the market hasn't decided which direction to go. When this pattern occurs in an uptrend or downtrend, it indicates that the market is likely to reverse. See another example below to learn more. The chart above shows how the market changed direction after the doji candlestick is formed. The market was trending up. This means the buyers were in control of the market. The formation of the doji candlestick indicates that the buyers are unable to keep the price up, and sellers push the price back to the opening price. This is a clear indication that a trend reversal is likely to happen. Always remember that a doji indicates equality and indecision in the market. You'll often find it during periods of rest after a large upward or downward move. When it is found at the bottom or top of a trend, it is considered a sign that a previous trend is losing its strength. So if you are already in that trend, it is time to take profits. It can also be used as an entry signal if it is combined with other technical analysis. Dragonfly Doji Pattern. The Dragonfly Doji is a bullish candlestick pattern which is formed when the open, high, and close are at the same or nearly the same price. The Dragonfly Doji is characterized by a long lower tail which shows the buyer's rejection and their effort to push the market up. Look at the image below. The image above shows a perfect Dragonfly Doji. The long lower tail suggests that the forces of supply and demand are nearing equilibrium, and the direction of the trend may be nearing a major turning point. See the example below, which indicates a bullish reversal signal created by a Dragonfly Doji. In the chart above, the market was testing the previous support level, which caused a strong rejection from this area. The formation of the Dragonfly Doji with a long lower tail shows us that there is a high buying pressure in this area. If you can identify this candlestick pattern on your charts, it will help you to visually see when support and demand are located. When it occurs in a downtrend, it is interpreted as a bullish reversal signal. But as I always say, you can't trade candlestick patterns alone. You'll need other indicators and tools to determine high-probability Dragonfly Doji signals in the market.
Gravestone Doji. The Gravestone Doji is the bearish version of the Dragonfly Doji. It forms when the open and close are at the same or nearly the same price. What distinguishes the Gravestone Doji from the Dragonfly Doji is the long upper tail. The formation of the long upper tail is an indication that the market is testing a strong supply or resistance area. Look at the example below. The image above illustrates a perfect Gravestone Doji. This pattern indicates that even though the buyers were able to push the price well above the open, later in the day, sellers overwhelmed the market and pushed the price back down. This is interpreted as a sign that the bulls are losing their momentum and the market is getting ready for a reversal. See another image below. The chart above helps us to identify the Gravestone Doji and how significant it is when it forms at the top of an uptrend. As you can see, the pattern has occurred in a clear bearish trend. The first candle confirmed the seller's dominance, and the second one created indecision in the market. The second candle can be a doji or any other candle, but the doji candle here indicated that sellers are struggling to push the market further down. The third bullish candle indicates that buyers took control from the sellers and the market is likely to reverse. This is how professional traders analyze the market based on candlestick patterns, and if you can master the formation of candlestick patterns and the psychology behind their formation, you will also analyze the financial markets this way. Evening Star Pattern. The Evening Star Pattern is considered a bearish reversal pattern that usually occurs at the top of an uptrend. The pattern is composed of 3 candlesticks. The first candle is a bullish candle. The second candle is a small candlestick. It can be bullish or bearish, or it can be a doji or any other candlestick. The third candle is a bearish candlestick. In general, the Evening Star Pattern is the bearish version of the Morning Star Pattern. See the example below. The first part of an evening star is a bullish candle. This means the bulls are still pushing the market higher. At this moment, everything is going well. The formation of the small body shows that buyers are still in control, but they are not as strong as before. The third bearish candle indicates that the buyer's dominance is over and a potential bearish trend reversal is likely to happen. See another chart which illustrates how the evening star can represent a significant trend reversal signal. As you can see, the market was trending up. The first candle of the pattern indicates a long upward move. The second one is a short candle, which indicates price consolidation and indecision. In other words, the trend created by the first long bullish candlestick is losing its momentum. The final candlestick has dropped below the previous candlestick, which indicates the confirmation of the reversal and the beginning of a new downward trend.
Hammer pin bar. The hammer candlestick pattern is created when the open, high, and close are all at about the same price. It is also characterized by a long lower shadow, which indicates a bullish rejection from the buyers and their intention to push the market higher. See the image below to see how it looks. The hammer is a reversal candlestick pattern when it occurs at the bottom of a downtrend. This candle is formed when sellers push the market lower after the open, but they get rejected by the buyers, so the market closes above the lowest price. See another example below. As you can see, the market was trending down. The formation of the hammer pin bar was a significant reversal pattern. The long shadow represents the high buying pressure from this point. Sellers were trying to push the market lower, but at that level, the buying power was stronger than the selling pressure, which led to a trend reversal. The most important thing to understand is the psychology behind the formation of this pattern. If you can understand how and why it was created, you will be able to predict the market direction with high accuracy. We will talk about how to trade this pattern and how to filter this signal in the next chapters. Shooting star, bearish. The shooting star formation is created when the open, low, and close are all at about the same price. It is also characterized by a small body and a long upper shadow. It is the bearish version of the hammer. Professional technicians say that the shadow should be twice the length of the real body. See the example below. The image above shows a perfect shooting star with a small real body and a long upper shadow. When this pattern occurs in an uptrend, it indicates a reversal signal. The psychology behind the formation of this pattern is that buyers try to push the market higher, but they get rejected by a selling pressure. When this candlestick forms near a resistance level, it should be taken as a high probability setup. See another example below. The chart above shows a beautiful shooting star at the end of an uptrend. The formation of this pattern indicates the end of the uptrend momentum and the beginning of a new downtrend. This candlestick pattern can be used with support and resistance, supply and demand areas, and technical indicators. The shooting star is very easy to identify and it is very profitable. It is one of the most powerful signals I use to enter the market. In the next chapters, I will talk about it in detail, and I will show you step by step how to make money by trading this price action pattern. Harami pattern, inside bar. The Harami pattern, pregnant in Japanese, is considered a reversal and continuation pattern, and it is composed of two candlesticks. The first candle is the big candle. It is called the mother candle, followed by a small candle, which is called the baby. For the Harami pattern to be valid, the second candle should close outside the previous one. This candlestick is considered a bearish reversal signal when it occurs at the top of an uptrend, and it is a bullish signal when it occurs at the bottom of a downtrend. See an example below. As you can see, the small body is completely enveloped by the previous mother candle. Don't bother with the colors. What is most important is that the small body closes inside the first big candle. The Harami candle tells us that the market is in a period of indecision. In other words, it is consolidating. So buyers and sellers don't know what to do, and no one is in control of the market. When this candlestick pattern occurs during an uptrend or a downtrend, it is interpreted as a continuation pattern, which gives a good opportunity to join the trend. And if it occurs at the top of an uptrend or at the bottom of a downtrend, it is considered a trend reversal signal. See another example below. In the chart above, you can see how the trend direction changes after the Harami pattern forms. The first bullish Harami pattern occurred at the bottom of a downtrend. sellers were pushing the market lower. Suddenly, the price started to consolidate, and this means that the selling power is no longer in control of the market. The bearish harami is the opposite of the bullish harami. It appears at the top of an uptrend, indicating that the buyer's dominance is over and a downtrend is likely to begin. When this pattern forms during an uptrend or a downtrend, it gives a continuation signal with the market's direction. In the next chapters, study in detail how to trade this pattern as a reversal pattern or a continuation pattern. Tweezer tops and bottoms. The tweezer tops formation is considered a bearish reversal pattern that appears at the top of an uptrend, and the tweezer bottoms formation is interpreted as a bullish reversal pattern that appears at the bottom of a downtrend. See the example below. The tweezer tops formation is composed of two candlesticks. The first is a bullish candlestick, followed by a bearish candlestick. And the tweezer bottom is also composed of two candlesticks. The first is bearish, followed by a bullish candlestick. So we can say that the tweezer bottom is the bullish version of the tweezer top. A tweezer top occurs during an uptrend when buyers push prices up. This gives us the impression that the market is still going up, but sellers surprise buyers by pushing the market down and closing below the open of the bullish candle. This price action pattern indicates a bullish trend reversal, and we can trade this signal if we can combine it with other technical tools. A tweezer bottom occurs during a downtrend when sellers push the market down. We think everything is going well, but the price of the next session closes above or at about the same price as the first bearish candle, which indicates that buyers are coming in to reverse the market. If this price action occurs near a support level, it indicates the possibility of a bearish reversal. The chart above shows a tweezer bottom that occurred in a downtrend. In the first session, the bears had pushed the market down. However, the second session opens at the closing price of the first session and goes straight up, indicating a reversal with a buy signal, which you can trade if you have other elements to confirm your buying decision. Don't focus on the name of any candlestick. Try to understand the psychology behind its formation. This is the most important thing, because if you can understand why it was formed, you will be able to understand what happened in the market, and you will be able to easily predict the future. Price action candlestick patterns practice. Now I think you have some information about Japanese candlesticks. You know the anatomy of each candlestick and the psychology behind its formation. Let's take this exercise to test your knowledge and see if you still remember all the candlesticks we've talked about. Look at the chart below and try to find the name of each candlestick and the psychology behind its formation. If you can easily identify these candlestick patterns and understand why they were formed, you are on the right track. But if you are still struggling to identify these patterns, you need to start learning about them again until you feel you have mastered them. Let's try to answer the questions about the candlestick patterns in the charts above. 1. Bullish harami pattern. Inside bar. The formation of this candlestick pattern indicates indecision in the market. In other words, the market was consolidating during this session. 2. Bullish tweezers. The market was trading up. The sellers tried to push the market down, but the buyer's reaction was even stronger. This pattern represents the battle between sellers and buyers to take control of the market. Engulfing bar. The sellers were engulfed by the buyers. This indicates that the buyers are still willing to push the market up. Engulfing bar. 5. Engulfing bar. 6. Engulfing bar. 7. Harami pattern. This pattern shows us that the market entered a consolidation phase during this session. So the buyers and sellers are in a state of indecision, and no one knows who will be in control of the market. Let's do another exercise. Look at the chart below and try to understand these candlestick patterns. Answers. Bullish engulfing bar. 2. Hammer. 3. Sad face hammer, which is big body plus small body equals harami pattern. 4. Bullish engulfing bar. Please, I want you to open your charts and do this homework repeatedly. You will find that with screen time and practice, you will be able to look at your charts and understand what the candlesticks are telling you about the market. Don't worry about how to enter and exit the market right now. Take your time and try to master the candlestick patterns discussed in the previous chapters. In the next chapters, I will equip you with strategies that will help you identify the best entry and exit points by combining technical analysis with candlestick patterns. Trust me, these price action strategies will turn you from a novice trader who struggles to make money from the market into a profitable price action trader. Market structure. One of the most important skills you need as a trader is the ability to read market structure. This is a crucial skill that will allow you to use the right price action strategies in the right market conditions. You are not going to trade all markets the same way. You need to study how markets move and how traders behave in the market. Market structure is the study of market behavior.